So let me start by, as usual, sharing my screen. So can you all see the PDF file of the lecture note here on the screen?
Yes, sir.
Okay. So we will start from the point that we left off last week. We were actually defining the trading strategy. So basically this is the multi-period model. For the multi-period model, so far we have defined what is a filtration, but in a very informal manner. You can of course see a much more formal version in stochastic process textbooks. We have defined the bank process and the stock price processes, which we call the risky assets. We have made the FT adapted assumption, again in an informal manner, just to fit in with our discussion here. And we are in the process of understanding what will be the trading strategies like, and of course our value gain and other processes in the multi-period version. So the trading strategy will be again a vector of n+1 items, n stocks and one bank, but now it will be a time indexed process because I have multiple times, and at all time points before capital T, which is up to t-1, I can actually reconsider my trading strategy. That is, I can revise my portfolio. So Hn is now indexed by Hnt, t equal to 1 to capital T. So now there is a little bit of notational work here, which we will clarify very soon. I said that I can make my decisions on day 0 up to day t-1, but I am indexing it by day 1 to day capital T. Why is that? That I will clarify soon. Now again we make the same assumption that Hn is FT adapted. So the decision on Hn has to be defined on all information up to and including time t. So that is also known as the condition that Hn is predictable. So if I have information up to date, then I can perfectly predict Hn because Hn is a function of that information. The value process and the gain process, we have to extend it to multi-period. So again, they have to be time indexed from 0 to capital T. And now this is the convention. The value process Vt is defined in the following way using the two-piece equation here. So look at this carefully because this is where the convention is clarified. V0 is defined as H0 at 1 B0 plus summation over Hn1 Sn0 sum over all the risky assets. So what am I doing? I am essentially using t equal to 1 values of H at time 0. Subsequently, for all other time points, I am being consistent. For time t, I am using H0t and Hnt. So this is the convention that whatever decisions I take about my trading strategy has to be taken before the time period. So Ht, the whole vector H at time t, that must be decided before time t. So it will be only based on information available up to time t-1, at the end of time t-1. So that's why when I am at time 0, I am taking an initial decision on the trading strategy, but that initial decision will be valid till the start of time point 1. So even at time point 1, the same trading strategy will be carried over. That's why it is indexed by t equal to 1. So that's why the V0 here is defined in a separate manner, in a different manner than all the other VTs. Is this clear? So it is, I'm taking the decisions before the time point. That is what is making this thing slightly different. And that is also the reason why this predictability is coming in. And that is also why my indexing convention for Hn is like this. I am indexing them from time point 1 to time point capital T, always understanding that t equal to 1 Hn will be decided at time 0 and t equal to capital T Hn will be decided at time point t-1. So this is an important convention, and it might get confusing if you are not following it here. So again, is this clear? Can you all just take a careful look at it and confirm if there is a problem with this convention, and the subsequent discussions then will be easier to follow.
So then the HNs of time point 0 and time point 1 are the same, but the subsequent are not.
Correct, correct. That is because there is no past at time 0. At time 0, the history starts. So I cannot have any past information.
But even then, why should the decision at time 0 and time 1 be the same?
No, the decision at time 1 will be different, but the portfolio weightages which are valid for time 1, that decision will be taken on time 0. As I said, my portfolio decisions are taken one period prior. So I decide on an initial weightage vector at day 0, which is also valid on day 1, because when I start my day 1, I still have no new information. The new information will come when the day 1 uncertainties are realized. And then I will take the decision for day 2. So I can adjust my portfolio on day 1, which new portfolio will be carried over to day 2. That is how the process is modeled.
But then shouldn't the date value be based on the next ones? I mean, why is there a difference in 0 and 1 but not in 1 and the
See, I could have simply changed the convention with time t indexed from 0 to t minus 1. But in that case, the only difference that would have made is the similarity would have happened at the end. That's all. The only important thing here is I can take decisions capital T many times. And those decisions are typically taken on day 0 up to day t minus 1. But they are valid for the next day. So it is one day ahead decision making. Because it's discrete time, we have to make that convention. Does it clarify your doubt or no?
it does almost.
Almost. No, I understand. I think almost is good enough. This is a little bit of a conventional way of putting things, which you have to carry along. And let us see. Probably it will become easier to digest as we go forward. Let's see. Because this predictability discussion always typically disturbs the students every year, which is fine. So the trading strategy is a portfolio weightage, which is decided on the day before. So for date t, my decision will be taken based on the information on date t minus 1. So that's why they become predictable. And the value function hence has to be defined in 2 parts using that convention, which you may or may not exactly like, but let us work with that. And delta SNT is again defined as the change in the stock price, but now we have capital T many of them, and our one period gain from any stock is then given by HNT delta SNT. Remember, HNT is decided on date T minus 1, and delta SNT is SNT minus SNT minus 1. So I will combine that. And get my cumulative gain. My cumulative gain from the stock over time will be HNU delta SNU U summed over 1 to small t. So if I want to understand what is my gain up to time small t, I will just sum over all the period wise gain. And to understand the gain of a portfolio up to time t, then I'll have to sum over all the stocks and the bank. So here, this is the cumulative gain from the bank, and this is the aggregate cumulative gain from all the stocks. So GT is my gain up to time small t. So again, GT is a process. Now note that using that same convention here, the essence are all FT adapted. So GT is also FT adapted. Is this clear?
Yes, sir.
Yeah. Okay. So just to make that slightly more maybe complete, that I am taking my H and U decisions beforehand, so they are perfectly predictable. And delta S and U is composed of two things, and one of them is already known beforehand. So this is the only new information which is revealed on time t. So it is definitely FT adapted. Okay. So with that knowledge, now let me try and explain a very important concept in trading strategy, in any financial trading strategy, which is called the self-financing condition. So before I go into any symbols or anything like that, let me just try and explain this thing to you. What is self-financing? Think of the value of my portfolio. The value of my portfolio is dependent on whatever decisions I take on the period before that. So the value of my portfolio at any time point t will be based on new stock price and at time t, that will be revealed in time t only. But all the other components of my value function are decided beforehand based on information up to time t minus 1. So if I notionally think of a time point slightly after period t but before period t plus 1. So I am not yet reached period t plus 1. So it is very difficult to talk about this in a discrete time model. But let us say that we are working on a stock exchange timeline. So my period, the time periods when my value changes can happen are when the stock market is open. And overnight period is the 0 hour, where there is no trade. So if I think of the overnight period, after day t, I call it t plus. So this is the convention here. So in continuous time, these things make sense very well, but in discrete time, I have to be careful because there is actually no real time between. So the time t plus is like that overnight time. What should be the value of my portfolio overnight? Notionally, I have got all the information from time t, so I am able to calculate h t plus 1, because h t plus 1 is decided on time at time t. So my value function will carry the new weightages for tomorrow, h0 t plus 1 and hn t plus 1. The t plus 1 stock price is of course not realized yet, so my current stock price is still SNT. And my current bank process value is also BT. So what is so great about it? This is what it should be like, right? Normally, if I have no restrictions, I can simply use some of my fund overnight, or I can add some extra fund overnight. In a mechanical way, there is nothing to stop me from doing that. But if I do that, then my VT plus will change. My VT plus will not be given by this equation here. So the self-financing condition formally written is given here slightly below. I say that a trading strategy is self-financing if VT plus will be equal to VT. So till the market is open again, till I enter date t plus 1 and get new information, my value of the portfolio cannot change. In other words, I am not allowing any changes. So no addition or no withdrawal from the portfolio in the overnight situations. So this is what I mean by self-financing. Again, is this clear? Because this is very important in trying to understand how we should time our strategy decisions. Because of course, in real life, this discrete time, nice kind of processes do not happen. Timeline is not so easy, but for any mathematical model, we want a simplified structure. So this is the structure that we are going to use. Is it clear? Self-financing?
Can you repeat again, please?
Yeah. So what I am saying is, at the end of time period T, suppose there is a notional overnight when the stock market is closed. What I am saying, what I am restricting myself to is, overnight I am not going to withdraw or add any fund to my current portfolio. So whatever actions I will take, I will again take on date T+1 when the market is open again. And those decisions will be based on new information. Based on the old information, after the period T is over, I am not going to do anything else. That's why if I have a notional overnight period where I could potentially consume something, which is withdrawing money or add some extra funds, even if I could do that, I am not allowed to do so. Is that okay, Madhuri?
Yes, yes, understood.
Yeah, so this is again, this is not a very formal definition. So if you look at a proper mathematical finance textbook, this definition is given in a much more comprehensive manner, but for understanding, this description usually works. So this self-financing condition we will be taking for the rest of the discussion. So even without mentioning, we are always going to look at only self-financing trading strategies. So that actually gives me a consistency in the result between value and gains. This result is very trivial, but if you think of the overnight trick, you will understand why this result is needed. The result is H is self-financing if and only if Vt is given by V0 plus Gt. Remember, Gt is the cumulative gain. And this cumulative gain comes from only the change in the stock price and the portfolio strategy changes. So the new value is comprised of the starting value plus whatever gains I am making in trading. So there are no other things happening outside the trading process. So that's what I said earlier, that self-financing restricts me from doing anything outside the market. So that's the result that we have. So whatever gains and losses that can happen only due to the gain in the market itself. Okay. So a few more definitions. This we have encountered earlier in the single period market, but we have to repeat them in the extended version. Discounted prices, Sn star T will be Snt by Bt now for each T. Discounted value process, again Vt star, and V star is the process, the whole vector of Vt star. How is Vt star defined? Again, I need two pieces, one for time 0 and the second piece for all the other time points. But what I do is I will discount by the bank process. So the bank process will vanish from the first term and all the terms inside the summation becomes Sn star. That is as it was earlier, only now I am looking at a multi-period version of it. Otherwise it's the same. Discounted gain, same way. I now define Gt star, cumulative gain up to time T, as HNU delta Sn star U, where Vt star is of course Vt by Vt. Again, if I restate my self-financing condition is now also equivalent to Vt star equal to V0 star plus Gt star. So whatever result we stated earlier for self-financing in terms of V and G, we can recast in terms of the discounted value and the gain process. This is just simple arithmetic, so nothing to explain really. The return processes are also going to be extended to multi-period. So I define a return process delta RNT. This is the new notation from earlier chapter. I had a single period delta R. Now I have to put T here. So that is delta SNT by SNT minus 1. If SNT minus 1 is strictly positive, otherwise it is taken to be 0. This is the usual division by 0 problem. So if I define my return process like this, I can also write my current stock price as an aggregate of the gross returns. So I can think of SNT as SN0 times all the gross returns accumulated over time, which is R plus delta RNU. So it is the same thing expressed in two different ways. All right, so that is straightforward. Return for the discounted price. If I want to define the return for the discounted price, that has to be done a little bit indirectly.
Sir, I have a question.
Yes.
So, is this going to be delta RNT or just RNT?
Now we call it delta RNT. This is the convention that we are going to follow throughout. You see, because later on we will have an RNT symbol for something else.
Okay.
So I just don't want to run out of alphabet. This delta was not needed here. This is just to distinguish.
Yeah, because that Rn star T is there without that delta.
Exactly. Because Rn I will use for something else. So I want to reserve Rn. So I put a delta here, extra delta. But Rn star symbol is unique for this discussion. So that is a safe symbol. So again, a bit confusing, but I don't want to use too many alphabets. In fact, Pliska also does the same thing. So I think that's fair enough. Okay, so Rn star I have to define in a roundabout way. Let me first look at delta Sn star. Delta Sn star I can write like this: Sn by B minus Sn star T minus 1. Why am I doing that? Because I want to introduce this delta Rn symbol here. These delta Rn symbols I want to introduce here so that I can factor out Sn star. But when I factor out Sn star, what I get inside is slightly more complicated. It is delta Rn minus delta R0 by 1 plus delta R0. And this then actually works as my definition for the discounted return Rn star. So I can maintain the convention of delta Rn star here, or just simply write Rn star. It won't matter because Rn star is reserved. That is given by this quantity. So if you look at it initially, it might sound a bit confusing, but what it is doing is the following. Think of this as a excess premium for a stock. The numerator is simply the excess premium, risk premium. If I put money in the bank, this is what I will get. So of course, stock is uncertain. So induce me to invest in the stock, some additional incentive must be given. So this is the risk premium, the additional incentive. But then I will get it tomorrow. So this is the nominal quantity. I will not actually get the value for this nominal quantity. I will get the discounted value for this nominal quantity, and the discounting will be by the bank rate again. So the role of the numerator here is to act as the benchmark. This is the risk premium. The role of the denominator here is for the time discounting part. I remember Subhrajyoti asking this time discounting question on the very first day, I think. So this is how we incorporate the time discounting here. So the present value question that you asked, this is our way of expressing that.
Yes, sir.
So this Rn star or delta Rn star now becomes this discounted risk premium. So that's the way to understand this discounted risk premium. And of course, we are going to connect it to our CAPM model, because this, you understand this is going to go back to the CAPM model again. But let me first finish with all the other few other definitions. So the return that we are going to consider is this one, but there is something new that I need to introduce at this stage, which was not relevant for a one single period market, but relevant now, which is called a dividend process. So what is a dividend process? Because I have a multi-period model, so it can be a long time in terms of historical time, maybe 2-3 years. It is quite possible that the companies may want to give a additional price or incentive to the shareholders for holding on to their shares for a long time. So these are incentives for loyalty, and these incentives are called dividend. So what is a dividend? A dividend is part of the stock value, whatever the current value is, a part of it is taken out and given to the shareholders in cash. So typically, dividends are a percentage of the share price awarded to the shareholders in cash. But then what happens to the company's valuation? The company's valuation gets reduced because you are taking some money out of the fund which represents your stock price. So now that your fund has reduced, because you have taken some money out, the fund has reduced, the stock price will also be reduced, because dividends comes out of the value of the company. So what will happen is, if I pay a dividend DNT on stock N at time T, the new stock price will not be the gross return times S&T minus 1. So this was what we had earlier. Earlier, when there was nothing like a dividend, this was our stock price process. So from one period to the next, all I needed to do was multiply it with 1 plus delta Rn. But now it will be less than that. It is this quantity, as it should be, minus Dn. So my stock price, the new stock price, is less than what I expected. So obviously, my return rates, the discounted return rates, will also be reduced. So typically what happens is, in the market, when the dividend is announced, there is a reduction in the stock price. The reduction in the stock price in this simplified setup is exactly equal to the dividend amount, but that does not always happen. Because you see, the announcement of dividend also has a news value, value in terms of information. And the stockholders also take account of that information and change their expectation. So what we see in reality is a combination of this pure reduction, pure cash reduction, and any other change due to expectation change. And that might be a positive quantity also. So you might see, even though a dividend of 3% was announced, the stock price went down by only 2%. Because the dividend announcement overall is considered as a positive information, so that implied 1% gain in the stock. All right. Is this dividend process clear?
Yes, sir.
Yes, sir.
Thank you. So with that, now I will again informally define martingales. So finally, we will define martingales here. So what is a martingale? So a stochastic process Z. So this is a general simple definition. A stochastic process Z indexed by time from 0 to capital T is a martingale if the conditional expectation of ZT plus S, so expected value at time T plus S, if conditioning on information available up to time T, which is Ft, will be equal to Z. So standing at any point of time, if you ask me about expectation in the future, based on the current information I have, I will always make the prediction equal to the current stock price. And there is a second condition, which is the absolute, the expectation of the absolute value has to be finite. This condition right now is not really necessary to check because we are working in a finite space situation. So this can be trivially checked. But in general, this is a critical condition. So expectation of modulus of ZT also needs to be finite. But what is the important part? The operational part is all future expectations are same as current value given current information. I can put it in a different way, which is also very informative, that all future expected changes are zero. So if I subtract ZT here inside, all expected changes in future are zero. And if you now recall our expectation of delta Sn star, you will see that this nicely ties in with our risk neutral probability structure. So basically, now I can say that I choose my risk neutral probability in such a way that the stock prices become martingales, or the discounted stock prices become martingales. Do you see that connection? So if I just write S instead of Z, talking about our stock price situation, sorry, not S, S star, then what I am saying that Q is chosen such that the discounted stock price becomes a martingale. Is that okay?
Yes, sir.
All right. So now let me go into the arbitrage opportunity definitions and extend them to a multi-period market. So first of all, arbitrage opportunities were identified with riskless opportunities for gain. So I make a gain in all states of nature. That was our arbitrage opportunity. In terms of our current scenario, because again, still all consumptions are made at the end, we are not consuming anything in between, because then it will not be self-financing. All consumption is being made at the end. We have to remember that. Even though it's a multi-period market, the multi-period is in terms of trading strategy decisions only. I can revise my decision every day, but I cannot eat. I can only eat on day T. So I want to mention this explicitly, because even though it is inside the definition, maybe it was not explicitly understood that my consumption can only happen at the last day when there is no uncertainty. All the previous days, I can do whatever revision in my portfolio, but I cannot eat. So arbitrage opportunities are defined in terms of what I can get in the end. So it is saying that I do not spend any money today, V0 is 0, but in all states of nature, I get non-negative consumption on the last day, and there has to be at least one strictly positive consumption so that my expectation is strictly positive. With that, I have to add one additional restriction now because of this multi-period and revision opportunities in my trading strategy. I add that H must also be self-financing, which means no intermediate withdrawal or addition of funds. So I start with 0, I invest it smartly throughout the time periods. In the end, I get a sure gain. That's an arbitrage opportunity. I can recast it in different ways. I can write the same definition in terms of discounted values, which will look the same, or I can recast it in terms of the gain function. In that case, I need not write a G0 star because that is 0. So by definition, so I can only write GT star non-negative with expectation strictly positive and of course self-financing condition. So these three are equivalent definitions of an arbitrage opportunity in this set. So is this clear? So did you all get me? Is this clear?
Yes, sir.
Yeah, because it is essentially extending the same single period definition. The only additional restriction we are putting in is the self-financing condition. And if you haven't noticed before, we are not allowing you to eat anything before the last day. Okay. So now with that, we are more or less done with the definitions. So now we can just start discussing the consequences. The risk neutral probability was as before, Q omega strictly positive for all omega. And now I can, formally say that Sn star is a martingale under Q for all n. So that expectation of delta Sn star equal to 0, that condition that we had earlier, I can now restate using the definition of the martingale and say that Q is chosen such that all the Sn stars are martingales. And that's why the risk neutral probability is also called equivalent martingale measure. So it is a measure because it's a probability. It is called martingale measure because it makes all the Sn stars martingales. It is saying equivalent. Why is it saying equivalent? Can you guess? Some of you have done some measure theory, correct? Can you tell me what is the implication of this word equivalent? It is not necessary for this discussion at this point, but some of you, I'm sure, are already aware of this. Anyone? I think some people last time asked me about the measure theoretic versions. So no one? That's strange. So did you hear what I asked? That I said that this equivalent martingale measure, the word equivalent has a connotation, and some of you should already know this. Isn't that true? So what I'm saying is that this word here. Okay, so just think of this as the condition that my state price density, L, is always strictly positive. So wherever I put P probability, I also put Q probability. And conversely, where there is no P probability, there is also no Q probability. Now, is this familiar? Now, does it match with something that you have studied earlier?
So Q is absolutely continuous with respect to P and P. That is absolutely.
Finally, somebody has made the connection. So that is the connection. Here it is trivial because it's a finite state space, very simplified structure, but in general, that is exactly what this thing means. And that's why it is called the equivalent martingale measure. Okay. So with that risk neutral probability setting result, if Z is a martingale, so any stochastic process with the martingale properties, and H is a predictable process, then if I define G as sum over H delta Z aggregated from time 1 to time t, so GT is the aggregate version, then this is also a martingale. This is actually a very simple, very easy result, because GT is nothing but a weighted average of delta Z's. So you can just show it 1 or 2 steps that, but the H being predictable is important, because whenever I am conditioning on time t information, H is already known. Otherwise, the expectation equal to 0 may not hold. Because if H itself remains a random variable, then H and delta Z may have correlations, etc., and the expectation may not be 0. H needs to be predictable. It must be known at time t. And then if Z is a martingale, then this G will also be a martingale. And if I just insert, replace Z by S, you know what I am looking at. So this is the result I am actually looking at, that if Q is a martingale measure and H is a self-financing strategy which is predictable, then V star is a martingale under Q. Is that okay? Is this result clear?
Yes, sir.
Okay, thank you. So this is 3.21. So I am still following the book, Pliska chapter 3. So equation numbers I am mentioning in some places. And the next result is regarding the no arbitrage opportunity situation. Earlier we had this similar result. The same result holds here also, that there does not exist arbitrage opportunities in this multi-period setting if and only if there exists a martingale measure Q. Same logic approach for a proof, that if I have a martingale measure, then all those rectangular sets, they coincide, and I have no arbitrage opportunities, and also that law of one price. We'll get to that law of one price. Another very important result, which is of course new here because of this multi-period setting, is the following result. This is a very important result, because this is what we intuitively always expect, but it needs a formal proof. That if the multi-period market does not have any arbitrage opportunity, so if I say that the multi-period market does not have any arbitrage opportunity, then none of the underlying single period markets can have arbitrage opportunities. So if over the whole span I don't have an arbitrage opportunity, then I cannot construct short-term markets inside between any small t and small t plus 1 which has arbitrage opportunities. Why is that true? Can any of you tell me why that should be true? Any guesses?
If in one time period I gain something using that arbitrary opportunity, then I can just invest that extra money to the bank and just keep adding that.
Perfect, fantastic, very good, very good. So it is basically a proof by contradiction. Once you get an arbitrage opportunity, I just put the gain in the bank. Then it's a sure gain. Thank you, fantastic. Okay, so this is a very important result. It sounds very obvious, but it requires a proof, and the proof is like this. Exactly what Subhrajyoti said. It's a very simple proof, but it requires understanding of the mechanism, that If once I get a gain, I need not take any further risk. I can just put it in the bank so that sure shot gain will remain with me till the end. And this is a one-way result. What can we say about the other direction? Do I need to prove the other direction? You see, it's if then result. So I did not write if and only if. Is the other direction needed to be proved? What do you think? Anyone here? I just said, so Shubhrajyoti has proved this one direction, which is nicely done. Do I need a proof for the other direction? Anyone? Okay, so think about that. Let me take a break now quickly because I have to finish slightly earlier today. So I want to resume at 11:40 so that I can stop by 12:30. All right, just for today because I have another meeting to go to. So we'll take a short break. We will restart at 11:40. Okay. So we were talking about these definitions, no arbitrage opportunity and its equivalence with the martingale measure, and also the multi-period extension and its link with the single period markets. So we have just understood one result, and I said that my question to you was that whether we need to talk about the reverse direction also. Can you now tell me the answer? That the result you now see here, do I really need the opposite direction proved? Did any of you think about it during the break?
Yes, sir. So I have one proof for that expectation thing to be greater than 0, but not for the for each individual omega. So if you just consider this expectation of Vt star minus V0 star, this we know that is greater than 0, and then we write it in terms of telescopic sum. So Vt minus Vt star minus Vt star minus T minus 1, and then plus of Vt. So at least one of them is going to be positive.
Yes. So the same logic that you gave for one direction, you can also use for the other direction. But you see, it's actually easier than that because the reverse statement can be shown to be true just by construction. If all the underlying single period models has no arbitrage opportunity, then you can just overlap them and by construction show that the multi-period market will actually cannot have arbitrage opportunities unless you put zero probabilities somewhere. You can construct it rather than actually trying to contradict. You can also construct. So all of you should think about these things because
So we can construct arbitrage. How can we construct no arbitrage?
as I said, think about it. It is just writing it down in 2-3 lines. It's not a long involved argument. Think about it. So and what I do urge you all to do is just think about this structure and how it plays out. because of course this structure is a very simplified version of the real life financial market, but this structure in itself is quite interesting. There are many interesting things that are going to happen with this structure. We'll see. We have already seen some nice results, but how do they tie in with real life data structures situations, that we will also see very soon. And in some cases, the matching with reality is quite good. So it's not such a bad model. So you should think about this model, how you can use it, and what happens when some assumption is not there, like can you find a different structure and so on. And of course, the maths is very simple. It's absolutely like school level, so that should not be an issue at all. Okay, so let me move on to a few of the consequences of this risk neutral measure definition and our additional symbols that we have defined. These are just straightforward. So if you look at EQ SN star T plus S, conditioning on time T, then it will be SN star T. So that martingale property can be used in a straightforward manner to show that conditional expectation of any future discounted stock price will be equal to the current discounted stock. That's a very straightforward thing. I can also use this in my return, the discounted return formula, and also show that delta Rn star T has the same property. So delta Rn star T plus 1 conditioning on Ft will be 0. Remember, delta Rn star is not actually return, it is actually risk premium. Delta Rn star is actually the risk premium that we have shown here. So under the risk neutral probability, you will expect to get 0 risk premium. That's what this result is saying. That again you can show directly from the definition. Okay. Why is it not moving? And this discounted return rates are usually the main components of calculation for our subsequent modeling exercises. Very often, instead of explicitly talking about the stock price, we normally build up a model using the returns. There are many reasons for doing that. Modeling convenience reasons. But most of the time, even though our financial market is defined in terms of SS, stock prices, our model discussions will focus on R. So if so far it is okay, then I will actually start talking about the model that I want to focus in case of discrete time measures. So, okay, so before I talk about the models, there is just last one comment that similar to the single period market, here also I can talk about the law of one price, because I have defined a linear pricing measure, that is neutral probability. So law of one price will also hold in this setting, just to make it a formal statement. Okay, so now I move on to the model, which is the most common, the most popular model in discrete time financial asset pricing, which relies on the binomial distribution. Yes, Vaishnavi. Did you want to say something or my mistake?
No, sir.
Sorry?
No, sir. It was by.
Okay, okay, fine. Okay. All right. So binomial model. All of you already know binomial distribution. You know that canonical coin tossing example, Bernoulli trials, and add them up, independent Bernoulli trials, you get a binomial distribution, binomial random variable and everything. This happens to be a very convenient tool for modeling financial asset prices. So what is the model? The model is the following. I look at the changes from one time point to the next as consisting of only two possibilities. There are only two possibilities. I can either go up by a fixed proportion or I can go down by a fixed proportion. And because there are only two possibilities, it is like a Bernoulli trial. So probability P and 1 minus P. And then it gets repeated every time period. Question, is this enough to model a real life scenario? Because only two possibilities at any point of time seems to be a huge oversimplification. It is a simplification, but it is not necessarily a huge oversimplification if you think through that. You see, my quantum of time, what is the length of time period that I choose, what is the distance between t and t plus 1, that is in my control. If you think of t as a natural 1 day, and then I tell you that, okay, there are only two possibilities, either up or down by a fixed percentage, you will definitely think that it is a too much of a oversimplification. But if I now tell you the no, my time interval is only 1 hour, then you won't feel so bad. In an hour, not too much is going to happen probably, so this might be a reasonable model, but still simplified. If I further say that, no, okay, let's take the time interval as 1 minute, then the model doesn't look so bad anymore. If I think of only 1 minute from now, the changes that are possible, that can be quite reasonably approximated by an up and a down possibility of a fixed proportion. And I can, of course, I have data, historical data, so I can calibrate the model. I can estimate all the necessary parameters. So you see, a binomial model is a very simple model, granted, but not necessarily an oversimplification of the financial market situation. Whether I can make the binomial model reasonable or not depends on how I choose my system configuration. In particular, how I choose my time interval. So if I can define a binomial model with short time intervals, it won't be a bad model. And in real life, with real data, people have tested this and have found that yes, binomial model works quite well if I take sufficiently small slices of the total time period. So let me do a bit of back and forth. Let me show you this website. This website is also part of the websites that I shared with you in the classroom, Google Classroom Drive. Okay. So this is a web page where you can study all sorts of binomial tree-based financial asset pricing models. Many models, all calculations are done numerically. So if you fill in the relevant parameter values here in these white boxes and say how many tree steps you want, so how many time steps you want, immediately the whole tree will be drawn and the asset pricing calculations will also happen here. So here the initial choice, so I have not yet explained all these things, but let me just tell you what happens when I change my time steps. So I changed it from 6 to 10. So basically I have 10 time steps. The total length of the time remains the same, but now it is sliced into smaller pieces. And that is what I was saying, that to make a binomial model reasonable, what you really need to do is select a reasonable time interval, a reasonable length of the time interval, so that your assumption of only two possibilities becomes a reasonable assumption. And that can be figured out looking at the data. So let me go back. So let us first discuss a little bit about the theoretical model, and then we will actually go to this numerical calibration sort of exercise. So I have these Bernoulli trials every time point. So from S at time 0, I start with S0. Now at time 1, S1 can be either S1U or S1D. And again at time 2, there will be two possibilities from each of these nodes. So it branches out. And we make a lot of simplifying assumptions. We assume that the changes are in a constant proportion. So S1U, S1D are basically U fraction above S0 or D fraction below S0, U greater than 1, D less than 1, and U times D is equal to 1, which means if I take one step up and then one step down, I'll come back to the same level. So these are called recombining binomial tree. So this is what this gives rise to, is called a binomial tree. And if I take these assumptions, it becomes a recombining tree. What is the advantage? Huge advantage. If I do not take the recombining assumption, then after 10 steps, I will have a tree with 2 to the power 10 many nodes. So it becomes huge. It grows very, very fast. But if I make it a recombining tree, then after t time points, there are only t plus 1 many n nodes. So that makes the model very, very simple. Of course, it's again a simplifying assumption, no doubt. But as I said, if we choose our calibration smartly, if we do our calibration smartly, we can make this a reasonable model. So the binomial model is the most popular discrete time financial asset pricing model. Typically, we use this recombining feature. We also assume that the probability is constant throughout time. So I do not say PT, I only say P. So the same P works for all the time periods. So all I need to do is estimate my parameters P and U. So it becomes a very, very simple thing to work with.
Sir,
Yes.
please explain this UB equal to 1 condition.
Okay, so you take one up step and one down step. What happens?
We came back to the same position.
Yeah, so that's what I am guaranteeing. So this becomes a recombining tree.
Okay, so at any point, if we go up or go and come down, or firstly come down and then go up, we end up in the same position.
So after any even number of steps, if number of up steps and number of down steps are same, then you are back at S0.
Okay.
So didn't you do any branching process earlier?
No, sir.
No. You did have stochastic process course in third year or fourth year somewhere, right?
No, sir. I'm from NB stream.
String is not compulsory.
No, so what? But you did not have any stochastic process introduction?
No, sir.
So we had Markov chain in our probability course only.
Okay. No, no tree, no branching process.
No, sir.
No.
Okay. All right, no problem. So then I will do the easy thing. I will just point you to the right material. Remember that we were talking about the MIT OpenCourseware? Can you see the Word file now on screen?
Yes, sir.
So look at these lectures, lecture 5 and lecture 17. So they have the initial material in a nice way. Okay, and after that you can easily read up the binomial tree model from Pliska, what we are discussing now.
Okay, sir.
Yeah, it should not be difficult, but if you still have doubts, you can always discuss with your batchmates, the Kolkata, the B stream counterparts, or you can ask me questions if you want, but it is very easy. So I think you will find this material very simple, so should not be an issue at all. So, but you have to do it quickly because we are going to use it every day from now. So this is a very simple example of such a branching process, and I have made it even simpler by the recombining assumptions. So end of the day, what we do see is that we need to only estimate two parameters: the probability parameter P and the step parameter U, and then the whole tree is known. So if I now go back to this binomial tree calculator here, you see, forget about the strike price, etc. This will come later. The underlying asset price starts from 30. Okay, so initial S0 here is 30. If you can see my screen, so this is 30, this is the initial. Okay, and we are assuming some volatility rate and some interest rate. We will explain this shortly, which will give me my value of U and D. So what is happening here? So with that calculation, in one single time period, I can either go up to 30.88 or I can go down to 29.15. So this is a small percentage change in two directions. Okay, and then of course it keeps branching out. The recombining doesn't happen exactly because of some, I think maybe some rounding off, but this is still a reasonably simple model that you can work with. So this volatility interest rate trigger, we will discuss now how we get our P and U from these calculations. Okay, so then just to tie it up formally, I'm using a stochastic process xt, t equal to 1, 2, etc., where each xt is a Bernoulli with parameter p, so that the partial sums nt, so sum of x's up to time t, will follow binomial with parameters small t and. So in our recombining version, the way it works is st, so stock price after time t, will be simply s naught times u power number of up steps, which is nt to omega, times d power the remaining number of steps. Because if I have taken nt many up steps, then I must have taken t minus nt many down steps. So my final stock price will be exactly this, and some of these UDs will cancel out, of course, because of the recombining condition. So it will be very easy to evaluate all the possible nodes. In our notation, the return rate here will be given by a single time point. It will be given by either U minus 1 or D minus 1. U minus 1 with probability P when I take an up step, and D minus 1 with probability 1 minus P. Remember, xt is the Bernoulli random variable. So this is my return rate. This is what I am going to calibrate from data. Okay. So again, for the sake of simplicity, we assume that the bank rate is a constant. That's what we have been doing, so no harm done. Bank rate is a constant. So my delta R0 is simply smaller for all t. Now, how do I calibrate my U and P? So the calibration is through the risk neutral calculation. I know that we are operating in the risk neutral probability setup. So my risk neutral probability must be such that expected changes after discounting has to be 0. In this binomial or Bernoulli setting, the calculation is very easy. What can happen? My up step is u minus 1. So I look at the risk premium u minus 1 minus r discounted by 1 plus r for one time period. This happens with probability q. That's the up step. On the other hand, the down step is just d minus 1. The rest is the same. But this sum, which is the expectation of change after appropriate discounting, must be 0. Is this clear? Is this clear to all of you? Just look at it carefully and tell me whether this is clear.
Yes, sir.
So, using our risk neutral idea, we can find the risk neutral probability for the Bernoulli setup, for the binomial model setup very easily, and that will be given by q equal to 1 plus r minus d by u minus d. So if I am given the values of r, u, d, etc., r and u, I can find the risk neutral probability straightforward. Of course, assumption is u must be greater than 1 plus r, which means in the up state, which is a good state, in the good state, I must get more than the bank. Because if I get less than the bank, even in the good state, then obviously no one is going to invest in this stock. They will all go away. So the up step must be better than the bank. That's for sure. So under that assumption, the risk neutral probability can be easily computed in terms of the model parameters like this. So then we know what we do. I have the p probability, of course, which is the subjective probability, which will come from individuals. But the market probability, the q probability, I can directly compute. And then I can put q in place of p in the binomial model to find the risk neutral calculations. Because for the aggregate pricing calculations, I have to do risk neutral calculations. So what I will do is, even though the small p for investors may be different, I will substitute it with the q that I find from here, from my calculation here, to calculate the risk neutral prices. Is this clear? Why we need to do this? Is this clear? Okay, so in reverse, if anyone has any doubts, please ask me. Because what I'm doing is I'm using a very simple model. The model is easy to describe, but I have to connect it with the financial market structure we defined earlier. So this connection is what I am doing now. So if this is not clear at this point, then subsequent things will be fuzzy. So if anybody has a doubt, please ask me. Is it okay? All right, so I take the default option, assuming that it's clear to all of you. So there are couple of things from stochastic process, particularly this branching process, that I want you to read up. Some of you may already know them, but now that I see that some people have no exposure to branching process kind of things yet, these are things that you need to read up. You can look at Hoyle-Portstone that I gave in the reference. You can look at Sheldon Ross, which is an excellent stochastic process textbook. They will all have very nice exposition of these topics. What I want you to understand are these things. So fast passage time and distribution of maximum value. Okay. So these two things here, fast passage time and distribution of maximum value, these are two problems that I want you to look up and learn. And in the process, you will learn a very important concept in stochastic process, which is called the reflection principle. Reflection principle happens to be a very, very important tool for studying such processes. Okay, so can you all please confirm that you have understood the requirement?
Yes, sir.
Because we will be using them subsequently, not right now, but we will be using this concept subsequently for finding the price for financial contracts, the derivatives that we are going to discuss very soon. Right now, we will continue our discussion with the easy model, but these two properties, these two probability concepts, I need you to understand clearly. Fast passage time and maximum value. Okay, so let me resume my old discussion. So I have already shown the connection between the risk neutral probability and the Bernoulli model or binomial model parameters. I want to take this forward. So to take this forward, first, I want to recap a little bit on Markov models. I know all of you already know Markov models, right? You know Markov chain, you said all of you know. Am I right?
Yes, sir.
Okay. So just quick recap. So I'll just go through it quickly because all of you already know this, the usual structure. So the Markov property is the probability distribution for xt plus s given the history up to time t is only dependent on the current value of the stochastic process. So the remaining part of the history becomes irrelevant if you are only given the current value. So that is the Markov property. So I don't need the rest of the history. And in particular, we call it stationary or time homogeneous if the transition probabilities that I will go from state I to state j in one time step, that probability is independent of the time point where I am starting. So the probability is only dependent on the two states and not dependent on time. So that's a time homogeneous transition probability. So it basically looks like a transition matrix if your state space is finite. We are working with finite state space. So for a time homogeneous process, our transition probabilities can be described in a nice matrix. Result. So if y is a function of current and future values of my stochastic process, then expectation of y given ft will also be only expectation of y given xt. So if I am given the current value, then any function of the present and future will become independent of the past. The past is xt minus 1 and back. So given the current value, the future becomes independent of the past. So it's conditional independence. Now, coming back to finance result. So if there are no arbitrage opportunities, if the discounted price process A star follows a Markov chain under the probability P, so I am saying that my A star is a Markov chain. So A star also has that memoryless property. So given the current value, I do not need to see the past. So the discounted price process A star is a Markov chain. And if A star is FT adapted, of course, A star must be only dependent on history up to time t, then there exists a martingale measure Q under which A star is a Markov chain. So what I am saying is, I start out with an FT adapted stock price process, discounted stock price process, which is a Markov chain under P. So it's a Markov chain under P. Then the result is, if there are no arbitrage opportunities, then A star is also a Markov chain under a suitably defined Q. So I can always find a martingale measure Q under which A star will be a Markov chain. So the Markov chain property is transferred to under Q, because we started out with assuming that it is a Markov chain under P, but if there are no arbitrage opportunities and A star is FT adapted, then A star will also become a Markov chain under the suitable martingale measure Q. Or we can find a martingale measure Q so that A star is Markov chain under Q. So is this result clear?
Yes, sir.
Because there are many conditions here. I need FT adaptedness. I need no arbitrage opportunity, but these are standard structure. We are only working with this structure. So I'm saying that the Markov chain property gets transferred. You can find the martingale measure Q so that the Markov chain property gets transferred from under P to under Q. So then I can write expectation of Sn star T plus S given S star T under Q is also Sn star T. For the martingale property, earlier we worked with the probability function P, but now I am saying that I can also replace this by Q. And this has very strong implications in the sense that when I start out my discussion of the financial market, I may not already have computed a risk neutral measure. I will be in the process of computing the risk neutral measure. But if in the process of computing the risk neutral measure, I lose the Markov property, then all my calculations will become very, very complicated. You see, I started out with the binomial model. The binomial model is Markov. I don't need to know the past. All I need to know is the current value, and then I can find out what is going to happen in the future. What is the distribution? So if this property no longer gets transferred for risk neutral calculations, then all my advantage will be lost. So that's why this result is a very important result. That when I have no arbitrage opportunities, then my stock price process Markov property gets transferred. So I can write this expectation under Q in the same manner. If my bank process is deterministic, which we usually assume that the bank process is deterministic, then our discounted price is ST by BT. So BT I can take out of my expectation. Then the calculation will also go through for ST. Because whatever adjustment for BT I need to make, that will be in terms of a constant discounting, 1 plus R power of T. So it will not change any of these properties. But we can say something more. we can say that when B is stochastic, even when the bank process is stochastic, we can still have this property go through, but with further simplifications. Of course, there is no free lunch, something that we mentioned on the first day. If I want to give up a deterministic bank rate, if I want to introduce a stochastic bank rate, then it has to come with certain restrictions. What is the restriction? The restriction is that the source of uncertainty is common. The source of uncertainty, the basic market force that creates uncertainty in the stock price, that same market force is creating uncertainty in the bank process. It's a very strong assumption. Some of you will immediately ask me, how can this be true? Like there are so many stocks and so on. How can the same force work on all of them? So indeed, it is a very strong assumption. This is called a single factor model assumption. But if I am okay with the single factor model assumption, then even for a stochastic bank process, I have the same transition, same transferring of Markov problem. Otherwise, it may not be true with a stochastic bank process. Is this clear so far? Because we are essentially trying to establish nice properties for different versions of the process. Discounting without discounting. And the discounting is through the bank process. So the property of the bank process plays a role here, which we are trying to understand. So is this clear?
Yes, sir.
All right. So with this Markov property that we have just discussed, we can also talk about the risk neutral version of the transition matrix. So for the Markov chain that we just discussed here, we said that for time homogeneous processes, the transition probabilities become a matrix independent of time. So in a similar manner, we can also talk about a transition matrix in terms of the risk neutral probability. So I can restate those same equation and say that this Q probabilities will constitute a matrix, similar way a matrix under which our X process will be a Markov chain. So the Markov chain property and time homogeneity gives me a nice matrix representation of the risk neutral probability. That comes in handy when we are doing calculations for large binomial trees. And with that, we have what is known as the risk neutral valuation principle. So this is like the same risk neutral valuation principle as in chapter 1. We have already discussed the risk neutral valuation principle for single period market. I can restate the same principle with normal usual additions here. So what do? I say that the time t value of a marketable contingent claim. So recall all the earlier definitions. Marketable contingent claims, those are attainable contingent claims, which means I can always find a corresponding trading strategy. For any claim, I can find a corresponding trading strategy. So time t value of a marketable contingent claim X is equal to Vt, the value at time t, of what? Of the portfolio which replicates X. This we have discussed before. And it must be true that Vt star, which is Vt by Bt, must be given by expectation of X by Bt, conditional expectation given information up to time t under probability Q. And if Q is not unique, even then this has to be true. So this result is for all the risk neutral probabilities Q. But of course, going forward, we will always try to make sure that there is a unique risk neutral probability. But as a general principle, we must say that It has to be true for all the risk neutral probabilities. So Vt star must be equal to conditional expectation under Q of x by Vt. X is the contingent term. So this is the risk neutral valuation principle restated for our multi-period model. Same principle, same consequence, but a formal statement is required because now this must be true for each time period t. Earlier there were only single time periods, so it was easy to state. Now this has to be true for each time period from 0 up to capital T. So is the risk neutral valuation principle clear? We have to think about it more because there are a few new definitions that have come in, but the essence of the result is same as the single period market result extended to multi-periods. So is the basic idea of the result of the principle clear?
Yes,
Yes,
sir.
sir.
So specializing to a complete market, because that is the nice market that we are usually working with. In case of a complete market, all claims are marketable and there will be a single risk neutral probability. Then I know that this result I can say for the risk neutral probability Q. That will be the nice situation because then I will be able to explicitly compute the risk neutral probability and then use it for all subsequent calculations. That will always be nice. But even if the market is incomplete, you have to remember that Vt star must be the same for all risk neutral probabilities. So if ever you are facing an incomplete market situation, you must remember that the risk neutral valuation principle must hold for all candidates, all candidate risk neutral probabilities. But subsequently, we will be only considering complete market calculations so that life is very simple, one single probability, and we can do explicit computation. Okay. So I will stop here with just two exercises from chapter 3. Did I mention the exercises from chapter 2 earlier?
Yes, sir.
Yes, sir.
Yeah. So chapter 3, there are only two exercises, 3.11 and 3.12. And of course, all the examples that are worked out in the chapter. So these things I want you to look at, read up carefully, verify that all the concepts are really clear to you. And Wednesday, we will discuss this further. So I hope that there will be questions and we can try and clarify things more, because after that we will move on to the actual financial contract pricing calculations. So the conceptual part is done. So the complete description of the market is over. This is the market. Now on this market, we will define all the financial contracts which are popular, some of them, not all of them, some of the popular financial contracts, and try to find their price. So the subsequent things will be basically pricing calculations. And those calculations will rely on the concepts we have developed so far using the binomial model. So make sure that the concepts are clear to you so that when we start calculating, there are no gaps. All right. So if there are any quick questions, I will take them now. Fine. I think you need a little bit of time to read things up. So Wednesday, we will start with questions and discussions, and then we will start on the actual contract pricing calculations. Okay.